Hey, Map here. Map Investments. So, let's take a look at a bar chart. So, a little thing. I guess I could just get rid of that. All right, bar chart. One of my mechanical things that I like to do during the day. Obviously, I don't like to buy options. I like to be a seller of options. So something you could do in your day when you have some free time or whatever during lunch or whatever. If you want to look for some trades, what I like to do is come here to. I don't know why it's so. This Google has been acting on so much. Maybe I should. All right, so you go over here to bar chart, right? And you go to most active options, and you see this column here, IV rank. I like to hit this here, and it sorts it by the highest IV rank. So I like to start with the highest IV rank and work my way down and look at the options chain to see if there's stuff that I like to put a trade on. This is aside from my long-term positions. I have some long-term stuff that I think is undervalued. Hasn't been treating me too well, like Alibaba and FSM, Tel, an oil play. I guess I could do a video on all those other ones, but I just wanted to do a quick video here on how to look for trades. I like to sell options. I like selling option strategies instead of buying them. So you don't have to fight decay. Options are a decaying asset. So every day that goes by, you get the decay. The decay is theta. It's one of the Greeks. Options are composed of four Greeks that make up the pricing of them. I only really concern myself with theta and deltas. I mean, some people like to get into gamma and vega. I really don't study that. I think if you look at those too much, you're overthinking it. And you just want decay working for you, and you want a high IV rank. That's just my opinion. I guess you can get more scientific if you like, with the Greeks and the whole option deal. So I did a video. My prior video was on Altice, which had 100 IV rank, and I did a put credit spread. And as you can see, there's several here. With 100 and goes down. Anything over 50 is great. I actually tried to do a trade in Las Vegas Sands. I don't know if I got filled. I did a video on Altice, CCXI. Let me see if I did a trade in CCXI. These are so I did do a trade in CCXI. I did a customized trade in CCXI. And I'll show you what I did, and I'll make this video about CCXI. I'm trying to use this thing here instead of Google, because Google's been very slow for me. So CCXI seems, I think it was a biopharma. You can see this thing, something came up here and it just got destroyed. Basically from 47.5 or $50 down to $10. But we can slowly see here a lot of accumulation and some buyers here. And the IV rank is at 100, so that means that there's a lot of options being bought or sold. See, what happens is when you have high IV rank, it means that there's demand for the options. So the options are, what's the word? Volatile, I guess. Expanding. So good thing to do is a selling strategy for getting credits. You don't really want to pay for a decaying asset. So what happens is that they're inflating because a move is expected, and that's why the IV rank expands. So CCXI, why is it doing this? I just want to go into what it's about. I wanted to read the notes on this thing. Oh, gosh. All right, here we go. So they had over 2.1 million shares. They've been trading about 1.3 in the last 10 days. And it is a little small biopharma with a market cap of over $1 billion. The news, let's see what the news says. So on the 9th, there was some unusual options activity, and it was bearish. So they have bearish. Maybe there's a FDA decision here. Let me see, market calendar. 3 more months for extended review of avacopan, a treatment for. Okay, so so it might be an FDA review of a drug. That's why the stock probably plummeted. So what I did was, let's take a look here. So this is the October chain, right? And what I did here, let's show the details here. Let's go to options. So I sold the 1750. Looking at the chart, it looks pretty bullish. I mean, you can see some accumulation here, and it got over the moving average here. Came back down a little bit, and then we're a little sidestepping up. So it's a small risk for a large reward if we get a pop, and that's what I did for a little credit. So what I did was I sold the 1750. Now these expire in 21 days. The expected move in the stock is $13. You can see it right here. Sorry. So let me close it. You see it right here, $13. That's the expected move. So what I did was sold the 17.5 and I bought the 12.5. And then with what I collected there, that was enough money to buy the 30 call. And I ended up collecting a credit of 7 cents. So I can try and get what I'm trying to say is I can collect a credit and try and get both trades to work. So if the stock goes up and it explodes to the upside, my put credit spread will expire worthless, and I keep that credit. And maybe if it goes up to 30, this will even expand even higher, the 30 calls. So we shall see. This is a biopharmaceutical play. It's it's a tough one. So this is a defined risk trade. So the most I can lose is basically $500, which is the width of 17.5 to 12.5 is the max paying there. Minus the credit I collected, 7 cents, which is not a lot. So that's what I did there. They look at the chart. Pretty much $15 was like, well, 15 bucks is the 50-day moving average. So that was a trade on CCXI. It looked to have some. Let me see what the put to call ratio was. Pretty even. 57% calls, 42% put, 13,000 options. So that's my trade on CCXI. I hope you like it. Try and kill two birds with one stone on this trade, with the put credit spread expiring worthless and a big move to the upside of any good news on the drug from the FDA. Hope you like it. Enjoy it, like it, share it, and I'll see you in the next video. Bye-bye.